herpes.
Whoa, bro. You just made the recording.
No, that part.
That's all good. I was talking about Corey anyways.
It's okay. Gage will make sure he clips that. He puts it on your social.
That's perfect. Gage is the best at that kind of stuff. Hi, Gage. Welcome. Sue Lau's in the house. Jean's in the house. Aiden Wong.
Hello.
Hey, Gage. How's the snow out in South Dakota?
It's melting.
Melting. That's good. Aiden Wong, nice glasses, bro.
Thank you. It's the blue light lenses since I stare at screens all day.
Where's the
Dude, you know what? I was gonna get a pair of those. Are those Oakleys?
No, they're not Oakleys. I don't even know. My wife got them off. I actually stole them from my wife. These are hers.
Oh, I like it. That's how we should roll. Always steal your wife's possessions. And you know what's funny is now my son is 15 and he's taller than Corey by like 5 feet. But
Sorry, I'm gonna put this on right now.
my son's at the age now where I can actually borrow some of his like shoes and stuff. And I'm like, it's kind of weird now that I'm actually stealing my kid's stuff. But
I'm sure they've stolen enough from you, so it's just a
dude,
little
every day my checking account with those damn Amazon orders.
Oh yeah, they don't stop coming.
They don't, dude. They don't. It's pretty crazy. It's awesome. You doing well?
Doing awesome.
Nice.
Can't complain.
Ian's got the whole office waking up at like 3:30. Actually, I wouldn't say the whole office.
We're trying. We'll get them there.
Get them up, get up. That's good. That's how we should do it. Dude, I've been trying to get Corey awake for the last like 8 years I've known him.
Yeah, I know.
Only
tired.
like 2 times has he ever gotten up early to go to the gym with me. 2 times.
I don't know, man. Now I think I can go with you now.
He sits
I've been in the
he
office
sits
at
in
4:30.
3:30 mornings.
That's good. That's good. Morning is a good time.
It is.
Good stuff. All right. Hey, Jeremy Mateo's in the house. What's happening, bro?
Yo, what's good?
Yeah, it's good. Your hair looks good. I know I saw you
Fine.
fixing it, so you know.
Trying. Damn, I didn't get the memo. I should have wore a tank too.
Dude, I literally came from the gym. I was meeting you guys know Mikey? He's a DJ. So yeah, it was super fun. And then I was like, oh my gosh, it's almost 12 o'clock. I gotta go. Corey gets upset at me when I'm late, so he like texts incessantly. You coming? You coming?
Iko, I want to see you one time on the call running and then ripping your shirt off like this. Like see the
Slow
that's,
mo.
that's a Jerry Mateo move, bro. That's not me. I do it with Jeremy, like synchronized swimming kind. There you go, Jeremy. Next time we're in the same town, we got to do synchronized shirtless dance off.
I'm down. Let's do it. Aiden can join us too. He'll choreograph it.
At 3:30 in the morning, apparently, bro. The guy's military, man. He hauls people out, no mercy, yells at you, no encouragement. It's all good.
All right.
up, Corey.
Kurt, how's it going, man?
Good.
Oh, I gotta do the email intro for Greg and Sheena.
Yeah, why don't you for next week? Up to you, but I do, like I always promise, do have an agent on here. She has some investment properties she'd like to share. So just let me know, Corey, when to start. And I can introduce
Yeah,
you
let's
to her.
go.
So,
These needs
Yeah.
good deeds. Let's take a look at it.
okay. So I have Jeremy, you probably know Colette Nishimura, Coldwell Banker. So again, this is strictly investment properties. Meaning if they have a property, it could be income potential. And that's the qualification to showcase this. And I make sure it's only that way and not to broadcast all these other listings. But Colette, you're on.
You guys can't see me, right?
No.
Can you hear
I can
me?
hear you.
It looks nice if we could see you.
Okay. I I can see me.
So we have Colette.
hear
and
me?
then- Yeah, we can hear you, Colette. And then we also have Joanne Lum of EXP. She has a investment property where you can build on, right, Joanne? So we're gonna start with Colette. Colette, I'm able to share my screen.
Let me do that.
Yeah.
Okay, can you hear me?
Okay, got it. Here we go. So this is Colette. There she is. So Colette, just a brief background, how long you been in real estate and what company you with, and then we'll dive into your listings.
I
Oh,
was
she's-
Global Banker Realty with almost well, I realtor for almost 10 years. I started with Century 21, Global Banker. I know a few so listings. I gotta say, I didn't so
Hi, Colette. I can, you know
You're
what,
breaking up. You're
Yeah.
breaking up. We can't really hear you.
So I'm gonna do this because I am not at home. I have a showing here, so I'm at my client's property and I'm getting internet
Okay.
off of my phone, which is probably why.
Yeah, that's fine. Colette, if you
You're
turn
doing
off your
good.
camera, it might help. Should I turn off
Yeah.
your video camera?
Off the video.
And then Colette, which property you want to dive into that's an investment property?
Okay, so those, they want their, okay, well, for investors, you can take a look at that vacant land. We just reduced the price. It is
Which one? This one?
3,800 square feet. Yes.
This one, the vacant land? Okay, I'm gonna click on this one.
Yeah.
Again, this is High Central, so this is public, so you guys can go on there and take a look at all the dynamics of this property. Is this the one, Colette? The vacant
Yes,
land?
it's 3,800 square feet. It's in Paoa Valley, so very prime location. There was a house there before, so it should have all of the sewer, water, and electric hookups ready to build. We're listing it for 825,000. The tax assessment for 2023 was 876,000. So well below tax assessment price. Very motivated sellers. There's like no vacant land in Paoa Valley. There hasn't been for years, but it's within walking distance. It's right across the street from Paoa Elementary School, right down the street from Booth Park, and obviously close to downtown. So very prime location. So that's listed for 825. Again, the sellers are very motivated. If you want to build something on there, that's awesome.
would they be interested in
Other
any type of
listings-
creative financing structure, Colette?
They'd probably be flexible. I mean, we haven't received any offers yet. So the only thing with this one is there's 5 different sellers. And they're all in different states in the mainland. So I have to just, if anybody were to put in an offer, I would ask for a few days because I've got to go and get all the signatures and confirmation from everybody that price, et cetera, is okay.
Well, the reason I ask is because right now to sell land like to an investor, it'd probably be best, just given the permit situation within Honolulu County, that
Yeah.
there's some sort of creative financing structure. I think sellers need to come to the realization that if they're gonna sell it to an investor or even a home buyer who's gonna build for themselves, like they stand to wait a long time, potentially even a year for a building permit, right? So I think if they're open to some sort of creative financing structure, where like maybe a lease option until permits, so that they can secure construction financing, then I think we might even be interested, so.
I'm pretty sure they are. I haven't spoken to them about that specifically, but I will. So
Okay.
yeah, and I'm sure they would be. They're not like in a real rush, but they would, yeah, I mean, they'd be open to creative financing.
Okay, cool. Well, yeah, well, thank you for sharing the listing, and if you have your information on the listing, right?
I do,
Anybody
but
else?
this is just one. As far as my other listings, I have, I mean, some of them are firm on their price. I know, because I'm an investor as well, that, you know, you folks want to get as a lower price as possible. You're gonna rehab it, that has costs. And then the flipping and whatnot, in today's market, interest rates are high. I totally get that. So I won't
Well,
go over the ones
just
that would.
real quick, Colette,
Uh-huh.
it's more about like finding out what they need. You know, it's not getting at the lowest price. It's really like if they need cash to sell the land now, let's just use a lot. If they need cash to sell, or like 100 grand, right? Maybe they don't need to sell the whole thing, but they need 100 grand, right? So maybe they can set up a structure where you can put 100 grand down, right? And then pay monthly with a balloon in 3 to 5 years or something like that. Or when permits are approved, so that they can get construction financing and then actually purchase the lot, right? So it's not so much that we're looking for the lowest price. We're just looking for the best solution for the seller for one, and then the best structure for us to profit, hopefully, on the back end. So.
Right, and I'm sorry, I wasn't talking about my land anymore. I was talking about my other listings that will stand firm on their asking price, like the first one there with the pool and whatnot.
Yeah.
But I do have one that I'd like to bring up that's not on there because it's not on the market. The seller is an inactive agent, so he does not want to put it on the market. He does not want to pay commissions. He wants to just have an off-market deal where he can get a cash offer. He is looking for a cash offer of about 2.5. That's what he wants.
2.5 million.
This is a 9. I'm sorry.
2.5 million.
Yeah, 2.5 million.
Okay.
This is a 9-bedroom, 4.5 bath multifamily. And the total square footage of the interior is 2,618 square feet. The lot size is 7,585 square feet. The structure was built in 1954, and this is in the Keolu area of Kailua. There's upstairs is a 2-bedroom, 1 bath. We're currently renting for $2,000 a month. Downstairs is a 3-bedroom, 1 bath, currently renting for $2,200. And then apparently there's a separate 3-bedroom unit that is being rented for like $850, something really low, because it's being rented to some elderly gentleman or something like that. And then
Well,
there's
just
a
looking off the
studio.
numbers, that one is probably not gonna, I mean, I wouldn't see that as a or you'd be buying for appreciation, basically. I think, you know, so at 2.5, if he wants cash, that's why it's always good to understand the motive, right? Because then you can potentially structure a deal. But if he just wants to go direct to seller because he wants to save on commissions, not because he's motivated or he's a distressed seller, then there's probably no reason an investor would come in to try to help. You know, we only cater to like 1% of the market, you know, like maybe even less. You know, we primarily have to deal with direct to seller sometimes, but distressed properties or distressed homeowners, right? So it sounds like he's not in distress. He just wants a discount. So he wants to sell off market, direct to seller.
Yes, because he wants to use the money for something else, but he also made mention that he got an estimate, and that includes stuff that's not like, I guess, required, just stuff that he wants. He got an estimate of $275,000 to repair a whole bunch of stuff, including adding PV panels. And then he said, yeah, once you do that, then you can sell it for, you know, over $3 million, because it is in Kailua and it's huge and it's multiple dwellings. But
Well, I put Colette's contact information on the side. Please contact her if you have any questions. And
Thank you, Colette. Best of luck with the listings too.
You can stay on if you want to. We're gonna move on to Joni. Hey, Joni, how you doing?
I'm good. How you guys doing? So I'm Joni. I'm with eXp Realty. I have a new listing. It's 96-151 Waiava Road in Pearl City. So this is actually like country living in the city. It's right behind Leeward City College. So this property is on a half-acre lot. It's pretty large. There's a duplex. There's 2 1-bedrooms in the duplex. There is a 1-bedroom, I want to say it's an ADU in the back. And then there's a 2-bedroom single-family home. On the right-hand side in front of the duplex, you'll see that grassy area. That was another dwelling before where they just knocked it down. There was a 2-bedroom house. That little spot, you can actually probably build a 3-bedroom house on it. The location is fantastic. There's renters in the units. The main house is vacant. And it's available. It's at 1.25 million. The tax, it's lower than the tax assessed value. I think it was at 1.4 for the tax assessment or property tax assessment value. And
What's the total
it's-
potential income, Joanne?
this one is around, I don't have the exact numbers. I'm guessing it's probably closer to at least 3,500. Maybe even 4,000 a month so far, because the front, that main house is vacant.
So the only play I would see here is if you can CPR and sell, renovate, and then the max, to take this property to its max potential, I'd probably renovate, CPR, and sell for an equity play, not so much cash flow. That's why Hawaii's not a cash flow market typically, right? Because you got to put up 1.25 million to make 3,500 a month, right? That's negative cash flow.
Yeah.
But as an equity play, like if there could be potential, it's still, I'd say, because there's 3 dwellings, right? Small dwellings. This is in Pro City. Okay, so it's 24,000 square feet or 5. So you could slice it up possibly 3 ways and sell 3 homes, right? And those single family homes, if you sold them separately, how much would they cost, right? That's your margin. But then again, you got to go through permitting and then the CPR process. So it's just longer holding time. So again, we go back to like the seller, right? Is the seller in a situation where they have a need that needs, filling that we can provide, where either come in with a quick close or come in with suitable terms that we can take over the property and, pay them, down the road or as we go. That's really how we get deals done. It's the asset, but also the person. Like, what is their issue? Like, what do they need? And if we can't fill that need, then I say, hopefully someone on the market can take care of them,
Right. The need for them, they just want to sell. So if it's a cash offer or financing, that's fine. But they just want to offload this property.
Got it. Oh, wow. That looked like the properties were actually a little bigger from that view.
Joanne, that's a really good sized lot. You're at almost half an acre or over half an acre. So if you haven't got a chance to go to DPP, that would be a really interesting play. It looks like it's zone multifamily as well. And being behind LCC, that's a perfect kind of a college dormitory. I mean, you could see LCC literally across the parking lot, right? So, I mean, this could be a great student housing type play. And if you could split it in half and then build on some additional units, like you said, I think that would be interesting. So maybe if you don't get a lot of movement this week, contact DPP and then jump on next week and let us know, because from an investor standpoint, that becomes really interesting. If there's a CPR perhaps ability, if there's truly a multifamily, how many units can be on each side or total? And then we try to figure out how to keep the existing dwellings and then add on a couple more units to maximize the rental income. The good thing is college students aren't really picky. So we can leave some of the older stuff there, but then add on to it and then create some fun stuff. And it could be kind of a nice little campus, like a little dorm campus, if you will. So, interesting.
Well, one thing I would check too, if you go down to DPP, is to make sure there's wastewater capacity in that area. Usually they can kind of open the map and kind of tell you right then and there roughly what they feel. They won't put anything in writing until you actually apply or request. But yeah,
Yeah, for
check
this
that
particular
first.
unit, it has a cesspool. So the city is
Oh.
requesting a plan. And you know, by 2050, all the cesspools have to be converted, right? So the city's just asking for a plan
Oh,
over
okay.
time.
Gotcha.
And there's 2 wells on the property. They're closed, but there's 2 wells on the property as well.
Okay. Well, thank you so much for sharing. And
Oh, you're welcome.
best of luck with the listing. Let us know how, how it goes. That one definitely could have some potential.
Yeah.
Thank you
Okay.
guys. But I wanted to move forward and because I wanted to make sure we have time because I think it's gonna be
Thanks,
very
Corey.
valuable for us.
Thank
We
you,
have
Paul.
Tyler and Kiko is gonna share kind of the deal that we're underwriting in Houston. So Kiko, take it away.
Are we ready? All right, everybody, welcome Friday. So as you all know, Corey and I co-own the Keiko Capital, great for lending. We also have a real estate side that is tied to EXP, so same place where Ashley's at and also where I think it was Colette was at. And on that side, what we do is we search nationwide for properties that would be good investment properties. We've been focusing largely in Seattle, Vegas, Texas, soon looking at Florida and also Arizona. One of the big things that obviously we all know is that multifamilies has a great opportunity. Instead of buying individual single families, which is a good business plan as well, when you do a multifamily, you get multiple units on the same property and you do 10 toilets or 106 toilets all at one time. So there is some economies of scale with multifamilies. We're sourcing multifamilies throughout the country, and Corey and I have set a goal for ourselves to acquire a number of single families. I think Corey wants to do 33. Is that right, Corey? 33 this year? It's some crazy number. He was smoking
I was
something.
saying 50 to make it even, but
All right, so it's a lot. And then my side of that goal is multifamilies. I really wanted us to get a 50 unit or greater. So today is kind of an interesting time. Corey and I have been underwriting a deal. Tyler is on our team, and Tyler is our director of acquisitions for small or mid-sized to large multifamily properties. So he's a resource to any of you if you're ever looking for multis and need help evaluating them. Today, you're going to see how we evaluate a deal. This deal is a 51 unit just north of downtown Houston. We're going to show you kind of how we do our deal blast. Tay said she's got a 12 unit coming up, so that'll be cool to talk through as well. What's interesting about this deal, Corey and I talked about it, is we want to make this an Ohana type deal, if you will. We want to give an opportunity that we can all hui together. And for those of you who are on today, we're gonna kind of run through the underwriting. And then if Corey and I decide to take this down, we're inviting some of you to consider joining us. And you can be an investment partner on it. But more than that, we want to use it as a group learning experience. I think that's Gene. Somebody want to mute Gene? So we want to make this a group learning experience. So anybody who actually invests on this deal, we're going to journey together. So we'll go down to Houston together. We'll walk through rehab plans together. We'll walk through interviewing our teams together. We'll walk through the whole process together. And so it'll be a great opportunity to learn, but it's also a great resume builder for some of you who are trying to gain some experience, because as some of you are discovering, when you get in the multifamily space, getting lending is a lot harder than a single family or a small multi 1 to 4 units. And so experience is a huge thing. And especially in this economy, underwriters are much more particular. In fact, I was just helping another client get a property, and the lender's first question is, give me your real estate owned, schedule of real estate owned. And the guy's like, I've got 2 multifamilies. And the lender said, not enough experience. So experience is huge. And so this will be an opportunity for some of us to jump in and really get the experience together. So with that, why don't we jump in? If you would like a copy of this analysis, drop your email in the chat right now. Rafi, will you jump into the Google Drive and add everybody's email who puts it in the chat to get access to the Google Drive? There's going to be a whole lot, I think. And if you don't want it, no big deal. You can watch as Tyler kind of goes through it. So Tyler Vanderveer is on our team. He's an amazing guy. He lives in Huntington Beach, literally on the beach, which is why he always looks happy and sunshine baked. Very experienced when it comes to multifamilies, has been underwriting multifamilies for several years now. Young, but an absolute hustler. And so it's a blessing to have him on our team. And so he and I have been underwriting deals ongoing now constantly for the last several months, and we found some good deals. We placed some deals. This 51 unit is one that we really like. It's off market. Originally priced at over 5 million. We've gotten to know the seller extremely well. Seller motivation is that he is a little bit older, and his dream is to actually write screenplays for Hollywood. And the building turns out inevitably to be a huge amount of his time. So he really wants to sell. So that's his motivation. We initially tried to find a seller financing type of situation. That just didn't work on this one. There was no assumption of loan opportunity. So this would be a straight out purchase. But we like it for a couple of reasons. So I'm going to let Tyler kind of jump in. Rafi, are you able to add everybody? Can you confirm if you're? Rafi's in here somewhere. I think he's listening. Yeah, he's listening. Rafi, in the Google Drive, just add everybody that's on the email addresses. All right, Tyler, go ahead and screen share and then jump in.
Alrighty. Can you see my screen?
It's loading. There we go. We see it.
Okay, cool. So this is the location right here that's called Northline Terrace Apartments, right? So one day I was just scrolling on CoStar trying to find some properties. I put in my buy box, over 50 units, Houston, and I drew a little map around the areas in Houston that I wanted to be in. And this property popped up, and I saw, I thought it was a great looking property. It had definite problems, but I mean, that's kind of an opportunity in our space. And I reached out because I wanted to figure out the pricing, and I reached out to who I thought was the broker, because on CoStar it had this guy's number listed as the broker. So I called him, and this is Joe. This is the owner who Kiko was talking about, how we built a great relationship with since then. And so let's get into the model. But yeah, this is the location right north of downtown, and I'll actually show you later why this location is important. So the financials of this property were pretty interesting because, like Akoa also mentioned, Joe basically self-managed it. So there's huge gaps in vacancy. The economic vacancy was upwards of 30%, which is a huge hit. But we figured that if we put in a better property management team and a better advertising and marketing plan, we could get that much lower and capture revenues there. And so, Kiko, where did you want me to start? Did you just want me to go through the model?
Can you start off with the cover? Start off with the cover sheet, the email cover sheet.
Okay. So I'll just use the executive summary because, well, actually, the cover sheet was not updated since I changed all the numbers. So,
Oh, gotcha. Okay,
right.
no worries. I was just gonna let everybody see. So yeah, so there's an executive summary, and then when you get access to the Google Drive, which Rafi's adding all of you now, feel free to read it. It's got tons of market information, data, stats, all the fun stuff. But let's just get into the fun stuff. So this particular spreadsheet, Tyler will walk us through. The highlighted yellow is where we input manually. So we design our analysis to be comprehensive, but yet simple. And the yellow sections is what we data enter. So Tyler, you want to walk us through that?
Yes. Okay, so the original price was $5 million. We got Joe to drop it down to 4.12, which we thought was a steal because he actually had an appraiser come in. I think it was 2020. Kiko, you could correct me if I'm wrong. And they evaluated it at, I think, 4.15 2 years ago. So we're getting it below that value, which is, like I said, a steal. And also it's because Joe wants to get out of it and write screenplays. So right now I have the property listed at 4.12, and I have the financing rehab at 600,000. And this is where it gets kind of interesting. So if you look at this rent roll, which I'll pull up here. So this is Joe's rent roll. And like I said, it was kind of shoddy because he self-managed it. So it's definitely unique in that way. So I went through and I kind of highlighted it. So all the highlights are the units that are achieving the market rents. And then, as you can see, there's 16 out of 51 vacant, which is a huge problem. So this was the market rent, and this is the current rent, and the effective rents are only $32,000, but the actual market rent is $51,000 if they were to fill it up.
So pause there a second, Tyler. So for for everybody's evaluation, just kind of background, whenever you go to a multifamily, always get a copy of their rent roll, which is what Tyler's referring to now. And then exactly what Tyler's doing is it's always good to assess how many units are vacant, because the value of the property should be based on the income coming in. So in some ways, having more vacant units is a good thing because it means that the value of the property is going to be less. So for investors like us, we want to pay as low as possible and then resell as high as possible. So that's a good thing in some ways that there are vacant units. The downside to vacant units is it does make financing a little more problematic because a lender is also looking at the income. So there's a little bit of a balance there, but it's solvable. The other thing that Tyler just said that's really important is to create a spreadsheet like he's done here that allows you to see what is the current rent per unit and what is the market rent per unit. And then what is the pro forma or the future rent after you do some renovations. So that's key to evaluating a multifamily property. And so that's what Tyler's done here. And Tyler, you probably kind of skip ahead, but that's a really good good introduction to how to review the rent rolls. If you've got questions along the way, feel free to drop them in the sidebar, and then we'll try to answer them as we go along.
Yeah, absolutely. So another thing, Kiko, that we talk about a lot is when there's a lot of vacancy, you can go in and get the renovations done quicker because you're not waiting for tenants to get out. So that's another benefit. But anyways, the reason that the vacancy here is unique is because it's not a loss to lease problem. The units that are filled with tenants and they're the newest leases, they're getting market rent, which is interesting because you would think with them only getting $32,000 a month, you would think, oh, they can't achieve the rents that they're asking, but that's not the case, which is why at 600,000, you can go in and that's a significant bump for 51 units. And you can go in and we're only asking for on the one bed smalls, $66 bump. And then on a one bed large, $68 bump, and then a 2x1 large, a $75 bump. And they're getting people right now that are actually, Joe just sent us an email. They said that a tenant just came in on the 2-bed and paid $1,200 for rent, which means these rents are very conservative. We could actually probably push it farther, but our job is to exceed expectations and not overplay our hand. So with that, I went through here and basically what I'm doing is I'm taking his financial statements, which I'll pull up here. It is, again, it's pretty shoddy. I'll show you what it is.
So while Tyler's looking at that, some of you are looking at the finance rehab or the rehab of 600,000 for 51 units. And if some of you are saying that seems low, that's very intuitive because theoretically speaking, 600,000 for 51 units sounds kind of low, but what you're trying to also balance is how do you not over rehab a unit to then put too much money in the rehab that you're not going to get it back in the rent. So remember on this, Tyler said our current rent, which is column N8-ish right there is the current rent. At 878, the market rent is 884. So what that tells us is that they're unimproved, outdated, deferred maintenance units are getting 878, which is only a few dollars shy of the market rent. That's great news because it means to us that to get up to the pro forma rent, we're going to push the market. We don't need to gut kitchens. We don't have to gut bathrooms, which means we don't need to do a $10,000 a unit rehab or $15,000 rehab. We're talking now just cosmetics, just a little bit of paint the cabinets, touch up the bathroom, stock vanity, and then clean the tile and not necessarily even do new LVP because it just a little bit of nice will help us to push the rents by, we're only looking at $66. So that's why this one will have a lower rehab because it doesn't make sense to blow $1 million on this property, which we are already achieving market rent based on its location. Location is right off the highway, not too far from University, few minutes from downtown Houston, across the street from a super Walmart and a shopping center plaza. So that's why it's got high rents. So as a result, we have a lower rehab budget. So that's good to know for everybody when you're looking at multifamilies, is to keep that in mind as you're estimating rehab. Is this good so far for everybody? Just nod your heads if it's okay, so we can kind of keep on rolling. All right, thanks, everybody. Tyler, go.
Okay, so this is the T12 that Joe sent us over, which obviously it stopped here. So it ended in August, and we had to kind of assume for the last 4 months and make estimates. So all this row is right here is the numbers from Joe. Okay, so this is what they're already doing. This number right here is the current effective rents minus vacancy. So this does not have to do with vacancy. This is an average of the units, the 1x1 smalls, without not including vacancy, because I'm not going to go in there and I'm going to put 0 for a unit. So this is not including vacancy because I add the vacancy here. And then this right here is their laundry income. And then, so this whole thing right here is the T12. So this is the past, what they've done in the past. So we take that to make assumptions about the future. So in the future, what I'm trying to do year one on the expenses is I'm trying to make it as close to what they already have proven that they're going to be paying in expenses. I'm not going to go less than that, but I'm not going to go way past it because that wouldn't make sense either. So that's what I did here. I made him as close as possible. There was some things like he didn't have a management fee and he had higher contract services. And then I added an 8% management fee, and I just balanced out the expenses in the way that I thought was best for year one, and then moving on through year 5. And then on the income year 1, I did something similar. I assumed that we're going to put in a better property manager. We're going to put in a better advertising plan. We're going to make the property look a lot nicer. We're going to drop the vacancy all the way down to 12, which is still very conservative. I could go and put 5 because I believe in our team so much, but that doesn't make too much sense. So at year 1, I have 12. Other income year 1, I added $55 a unit for RUBS, which is utility bill back. And then I have $5,000 for laundry for the full year. So that's what I did for the T12 in the year 1. Now moving into the 5-year pro forma, this is where we actually get to look at our numbers. All right, so starting on the top, rent and the other income inflation. So this is what I was talking about with the location, right? So it's right here. So this is considered, according to RealPage, was a data collecting tool that comes out every quarter with the exact predictions and the forecasts for the average annual rent growth. So it has, these are all the different submarkets in Houston. So it has them very specific based on their area code or whatever that, there's probably 3 different area codes in each little submarket. So for this property, Northline Terrace, it's North Central Houston, which is actually the highest projected rental inflation in the whole entire city of Houston. So what I did is I took this is 2023 to 2027. So it's starting 7.4 and it ends with 3.5. So I took an average, which again was probably pretty conservative, at 4% straight line through year 5. So that's how I came up with that number. And this is here to back it up. Economic vacancy, I talked about that being 30. I dropped that down to 12% year 1 because of what we're going to establish in the property and make it much nicer. And then year 2, I still have it at 6. And then after that, I straight line it at 5 till year 5, I go to 4 because I feel like at that point we'll be very stabilized. And that's probably a little bit conservative too, but I think that's fine. Expense inflation, I straight line that at 2. That's pretty standard practice for what I've been taught and how I've been underwriting for a few years. And then the reduction in utilities, I added the RUBS on the front end, which was right here. So I added 55 a unit here, which is inflated, as you can see here, straight line across with this 4% bump due to this marker here. And then the gross potential rent, this is all just being calculated from this number minus the vacancy at 12%, and then the other income being added on top of that to get your net rental income. And then we've already talked about the expenses. And then here's your NOIs, your debt service is here. So Coco, do you want to go ahead and talk about what they were thinking about the financing plan?
So go ahead and go back to that last one, Tyler. Couple things to point out. So as you heard from Tyler, I think it's very important to have backup documentation. So we use RealPage because that's what their job is. RealPage does this. So that's where we get our data sources there. So we try hard not to guess. In real estate, as we all know, it should not be emotional. It shouldn't be guesswork, but it should be informed pro forma. So informed budgeting, informed statistics. And we try to be really conservative. We could launch another version of this, which is the aggressive, if we go all out, what could we get? But we like to go streamline. And then, like Tyler said, have a return that's so much greater. But we feel good if it checks off all the boxes to buy based on conservative numbers, then we feel really confident going in the deal. So that's why those assumptions are very fair. When you go to the bottom and all the expenses, that's all projections based on actual. So that's fairly conservative, but it's also based on our experience of what we've seen from other properties. But what's fun is that if you go down to the bottom, you get to see your net operating income. You get to see how much goes to debt service. And then you get to see your cash on cash return. So obviously in year one, we have lower cash on cash because we've got some vacancies and we're investing more cash into the project. But by year 5, we're at 16% cash on cash return. That checks off our buy box because on average, we're over 11% cash on cash. So that's fantastic. We take a look at the debt service coverage ratio. Year 1 is 1.4 all the way to 1.9. That's fantastic. From an underwriting and lending perspective, that's a great DSCR. And then what's fun is to take a look at the reversion value. Reversion is another word for what's the money I'm going to get when I go sell it at some point in the future based on the cap rate at that time. So a cap rate, as all of you know, is a metric for comparing assets, asset to asset. And so, yeah, so Tyler put in 7.5, and we did that based on our research of Houston and the type of properties and what we think will be the cap rate that we would sell at in the future. And so
it's conservative.
And it is conservative. Tyler, what were you finding that were on the aggressive side? Cap rates of?
Yeah, 5s, low 5s, it depends. Back during COVID era, like last year, everything was 4s, low 4s, but since then everything's gone up with the interest rates.
So if we had put in a 5 cap reversion value, we would have even higher values, but we're conservative. So at 7.5, it means that if we buy at 4.1, put in 500,000, we're all in at about 4.6 with closing costs, maybe 4.7. So we go to the reversion cap rate, and then now we see the value after year 1, we're at 4.8. That's pretty good. We cover all of our costs. But what's exciting is by year 2, we basically made $1 million. We're at 5.6. By year 5, we basically made another $1 million. We're at 6.7 reversion. So that's important to us because we want to know at some point if we bring in investors on a deal, maybe we want to pay them out in year 1 or year 2. Let's say we're going to hold their money for 24 months. They're coming in at say $200,000-$400,000 a piece. We want to pay them a return. When can we safely do that? As the primary investor on a property? That's when we look and say, hey, we're going to have $1 million of equity by year 2. So could we pay back all our investors if we say we raise the full amount of the down payment, which is on page 1, Tyler, is 1.4 million. So if you go to the first page that we do, we see the down payment amount at 1.4, which includes all of the costs relative to acquiring the loan. So we go to the second page, Tyler, and then we see that by year 2, if we raised all of the money, 1.4, we would be able to pay back $1 million of the 1.4 we raised. By year 3, we would be able to cover all the down payment. So if we raised 1.4 from investors, this tells us that by year 3, provided everything goes well, assumptions go as planned, we could pay back the 1.4 million to all of our investors. We satisfy the investors. And now Corey and I then get a chance to say, we now own the property. We paid everybody back with the equity. Do we want to hold it longer and then now just make it a cash flow play? Do we want to refinance it? Or do we hold it 2 more years or another year and then make some more money on it? So that's why reversion cap rate can be really, really helpful. So that's pretty exciting. And then let's see. Anything else on this page? I think that's pretty good, Tyler. How's that for everybody? Any questions so far? That was a lot of data, and a lot of information.
Yeah.
Tay always has good questions. Tay, got a question? She loves the sheet. I love it. Well, you have it now in your email, so you guys can copy it. And that's totally fine. We're constantly revising it. Jeremy, what about you? You guys were just evaluating a deal in Florida, so this is very relevant for you. How does this compare to the analysis that you guys were doing in Florida?
Oh yeah, this is super thorough. I'm just like reading this and everything that Tyler made. I'm like, yeah, we definitely were not ready for Pensacola. And then for those asking, we just canceled yesterday. Our due diligence period expires tomorrow. And yeah, we learned a lot. We definitely underestimated trying to get financing. So we're definitely looking for the next big multifamily deal. And this time applying everything that we learned from this cancel deal into the next, and definitely stealing Kikoa's sheet.
Oh, it's Tyler's and mine. Tyler's which is awesome. And we're a resource, right? We're a big ohana, and we want to help everybody succeed. When the tide rises together, then we are all successful together, and that's really our heart. But that's good, Jeremy. Any questions then based on this analysis that you would say, hey, if I had to recreate this for another deal of my own, do you feel confident about it, or what questions do you have to help you populate it?
Tay says, make sure you create a duplicate of the sheet. And don't edit the formulas. I'm assuming is what you're saying, right?
I think it just is on view access.
Gotcha.
Oh, Kikoa, you're mute.
Nicole, you're muted.
Oh, sorry. Go ahead and download it if you can, and if you need, then you can manipulate it. Because we'll probably remove everybody from the file folder after the call, because there's a whole bunch of other stuff in there. Unless you want to be an investor. So, Corey, what about you? What other questions do you have? Well, you and I have already reviewed this, so that's probably that's not a very fair question. I should ask somebody else. Is Layla or Alex on? They should. Layla's on, but she's obviously.
That was a clear. I mean, to me, it was very clear, and I've seen it already. But it was fast. We did go through that fast. So we'll probably. I think I don't know, but I love going through deals like this. I love deal analysis. How'd you find it? How'd you fund it? All that. So maybe I think we should do more. Especially live deals that are being underwritten right now. Like we learn the best from those, in my opinion.
Yeah. Well, so for everybody, we're almost up to 1 o'clock. Layla's not feeling well, so she just messaged us. So prayers for Layla that she feels better. But feel free to ask questions if you ever have questions. Tyler, will you drop your email address in there? And then if you need questions for Tyler, we're here to help. We're here to serve. But Corey and I have evaluated this, and I think we're pretty confident we're going to probably take the next step, which the next step on this deal, it's off market, is to lock it up. So we're going to actually put earnest money down. We'll go into an inspection period, which then gives us a chance to get our inspection money back. We're going to review all the financials again. We're going to review the inspection report, sewer scope, all of that. So we're going to go through the whole journey. While we do that, we do want to give you all an opportunity. No pressure. We don't mark friends based on who does business with us. We do friends because we're friends and we're family. But if any of you are interested in journeying, a few of you have already reached out and said, you'd like to. We're not we probably won't be doing something where it needs to be accredited investors. So that's kind of nice. We're looking at not doing a full scale syndication on this one, but much more of a lender type situation. And we're still trying to figure out the returns. It'll be fair on the return side, but extremely fair on the learning side. So what Corey and I plan to do is we'll go down to Houston for the inspection. For those that are investors, we'd get to come down with us. We'll hang out, we'll mastermind. We're going to learn together. You're going to hear how we process. Tyler and I do this all the time. We do these inspections and negotiations, and you guys will get to hear all that. Corey will be a part of this whole conversation. And then as we think through, how do we ask the seller for more money off? So we're at 4.1, it's under the appraised value, under the list. And so we want to be able to try to figure out how to get a little bit more money, even off of that, because that'll make our returns even that much better. So yeah, so I mean, we definitely want to take a look at that. If you're also somebody, Corey and I were brainstorming, if you're somebody who may not personally have the cash to invest, but you can bring in a couple investors, then we would still include you in the mentoring portion of that. So if you're somebody who's like, oh, bro, I can raise money all day long, and this is a deal that I could easily raise money for, that's totally cool. Corey and I can raise this kind of money, but we really wanted this to be more where we included more people. So that way it's a little bit more of a journeying together. And we've been talking about this on Coffee Talk for almost 3 years, right? That we want to do a deal together. So we definitely want to do that. Tay wants to know what the minimum is. Tay, for you, it's only $1 million. So special, Pake special for you, $1 million. Yeah, you know, I mean, we're going to probably be raising right around 1.4 to the 2 million mark, you know, depending on, because here's a good line of thinking for everybody is at 1.4, that's the down payment, 25% on the 4.1 million. The rehab could either be financed if we get a bridge loan or we pay cash. So we still, Corey and I just need to evaluate that, but that's what the due diligence period will be for, is while we're in due diligence for 2 weeks, we're already going to be sourcing all of our bridge lenders, all of our lending sources to find the right lending product. So that way we know before the end of the inspection what lending looks like. We will have a financing contingency, but we'd rather go to the seller early while there is momentum to ask for a credit or for him to buy down our interest rate, right? So we'll be raising anywhere from that 1.4 to the 2 million, because the 2 million would cover all the rehab. We won't need to rehab all the units, I don't think, because again, we're close to market. But for Tay's question, yeah, probably 100 to 200 is probably good, because then if it's 1.4 million at 100 each, that's 14 people. That's quite a bit to have in a hui, but at the same time, it could be really good. And then 200K is great as well, right? Because that's just less in terms of investors. Blaze question is great. 70% occupancy is low for financing. So as we alluded to earlier, so the upside of vacancy is that from a value perspective, that's how we got the price to 4 million. He could get 5 million if he had full occupancy, but or 5 to even 6 million, right? Because at 4 million, we're accounting for the fact that he's not making that much money. Now, from the lending perspective, there's a downside. Fortunately, we've already got relationships with a number of bridge lenders. And for bridge lenders, they're looking at pro forma, they're looking at future performance, they're looking at the asset and the experience of the team. So we should be able to do that 25 to 30% down mark is what we're looking at. And like Tay said, great negotiating power. Corey, anything you'd add?
No, that was great. I mean, one thing, so I just want to make sure that it's that everyone's paying attention in the environment that we're in, and then looking and then evaluating where you are in your career. Where is your strengths in your knowledge, in your network, in your resources that you have, right? Because in this times where the market is shifting, the opportunities are shifting, right? Like for us, I've been studying single family and actively investing for over a decade now in the single family space. Do I know multifamily? I do. You know, I know how to underwrite because we fund multifamily as well. But I don't know the in-depth of boots on the ground, the inspections and balancing and underwriting a multifamily asset like Tyler and Keikoa does, right? So during these times when, especially the single family market is trending down in some very attractive markets across the nation, I'm going to focus on single family, right? And I just want to put it out there to everybody that you should evaluate your own situation, and maybe single family is better option for you, and maybe multifamily is better option for you, right? It's different. It's where is your network? Where has your experience been? Where is your resources? right? Do you see yourself aligning yourselves with partners if you're new to the multifamily space or single family space? Are there partners around you that you can, lean on in these times? Because I know for single family, it looks like we're gonna have a window of opportunity where things are gonna be on sale, right, in some markets, right? And so for me, I've been waiting my whole career for this. I'm not going to blow it by getting distracted and trying to learn multifamily, learning a whole new underwriting, learning a whole new financing structure and capital stack, right? Knowing everything about that asset class to take full advantage. Like for me, that would be a mistake, right? In this times where single family is going to be where the distress is in some markets. So for me, I'm doubling down on single family, and I'll back up Kekoa and Tyler as needed, right? Perhaps in the financing side and a little bit of the underwriting side, because I can see what the lenders will underwrite for as well. So my whole main point is that whether it's single family, multifamily, in these times, like evaluate where you are in your career and then the best options for you moving forward, whether it's single family or multifamily, commercial, notes, tax liens, any strategy. Just make sure you don't get distracted, so go with what you have and double down in these times is what I'm thinking. And let's say you are investing and you are primarily a single family equity player, like you flip houses or you build ground construction. And in these times, it's a little uncertain for you, right? But you've always wanted to get into multifamily. That was the next step for you. Well, perhaps this might be the best option, is to lean on like a crew like ours and lean on the underwriting and all the experience and learn while also getting to participate and get a nice healthy return, right? And then so when the market turns back and you're ready to go back to single family, and flipping houses and all that, then you'll be ready to go into multifamily too, right? So the main thing is don't sit on the sidelines, evaluate where you are in your career and what the best move is for you. And just make sure you're not just following the herd, whether it's single family or multifamily, right? Just make sure it's the best for you and what your goals are. That's it.
I love it.
Happy Aloha Friday, everybody.
Thanks, everybody. So if you have any questions on multifamilies, always email Tyler or myself. Happy to help you out, especially if you're evaluating something. And then if you have any interest to join Corey and I, just shoot me an email. We'll answer some questions. Again, no pressure. We're going to move forward anyways. We think it's a good opportunity. It'll be fun. So have a great weekend, everybody. And if you're in Vegas or near Vegas, we got a meetup happening tomorrow at 1 o'clock at our 160 unit. And happy to have all of you there, whoever's in the Vegas area.
And don't forget, we're going to be at Zasha and Fuzzy's event on the Big Island tomorrow. Is that tomorrow? That is tomorrow. So anyone on the Big Island, kind of reach out. Maybe we can kind of just say hi, have coffee or something with the team. Have a great weekend, guys. Happy Aloha Friday.
See you, everybody. Have a good one.
Have a good one.
Yeah, I think this one is a perfect size. So, okay, cool. It just jumped on. Happy Aloha Friday, everybody.